Investing can seem daunting, especially for beginners. With so many options out there, it's easy to feel overwhelmed. However, the key to building long-term wealth is to start investing as early as possible, even with small amounts. As the saying goes, time is your best friend when it comes to investing. By getting started today, you can harness the power of compounding and watch your money grow exponentially over the years. In this comprehensive guide, we'll explore 5 different investment strategies that beginners can use to start building their wealth in 2025. From individual stocks to real estate investment trusts, REITs, cryptocurrencies, gold, and index funds, we'll dive into the pros and cons of each approach, helping you make an informed decision on the best path forward for your financial goals. Remember, investing always carries some level of risk, and it's important to do your own research and consult with a financial advisor before making any decisions. With that said, let's get started on your journey to financial freedom. Individual stocks. The thrill of owning a piece of a company. Investing in individual stocks can be an exciting way to build your wealth, as it allows you to directly own a piece of a company you believe in. However, it also comes with a higher learning curve and risk level compared to some other investment options. To be successful in picking individual stocks, you'll need to do your due diligence and dig into the fundamentals of a company, including its financials, leadership, and brand recognition. This can be a time-consuming process, but it's essential to increase your chances of making profitable investments. One way to get started with individual stocks is to use a beginner-friendly investing app like Trading 212, which offers a demo account where you can practice trading with fake money until you feel confident in your strategies. This can be a great way to learn the ropes without risking any real capital. When it comes to the potential returns, individual stocks can offer both passive income through dividends and capital appreciation if the stock price increases over time. However, the risk level is also quite high, as a single stock can plummet in value or even go out of business, potentially wiping out your entire investment. Learning curve. High requires in-depth research and understanding of a company's fundamentals. Passive income potential. Good. Potential to earn dividends and capital appreciation. Tax efficiency. Great. Can be held in tax-advantaged accounts like ISAs or Roth IRAs. Risk level. High. Individual stocks are susceptible to significant price fluctuations and potential losses. To illustrate the potential returns and risks of individual stock investing, let's look at a hypothetical example. Imagine you invested $100 in a random selection of 20 different stocks 4 years ago. As you can see, the results can be quite unpredictable, with your investment now worth $67.76, representing a negative 32.34% return. However, if that same $100 had been invested in other high-performing stocks like Apple, Microsoft, or Nvidia, the results would have been vastly different. For example, a $100 investment in Apple would now be worth $170, Microsoft $188, and Nvidia a staggering $908. This example highlights the importance of being strategic and well-informed when investing in individual stocks, as the market can be highly unpredictable. While the potential for significant returns is there, the risk of losing your entire investment is also very real. Real estate investment trusts, REITs, investing in property without buying a home. Real estate investment trusts, REITs, offer a unique way for beginners to invest in the real estate market without the hassle and capital requirements of buying a physical property. REITs are companies that own and operate income-producing real estate, such as office buildings, shopping centers, apartments, and hotels. Investing in REITs can be a great way to diversify your portfolio and potentially earn a steady stream of passive income through dividends. The learning curve for REITs is moderate, as you'll need to understand how they work and the different types of properties they invest in, but it's generally less complex than buying and managing a physical property. One of the key benefits of REITs is their tax efficiency. In many countries, including the UK, you can hold REITs in a tax-advantaged account like a stocks and shares ISA, which means your dividends and capital gains will be shielded from taxes. While REITs are generally considered less risky than individual stocks, they are not without their own set of challenges. If the real estate market experiences a downturn or the REIT struggles to keep its properties rented, you may see a drop in both dividends and the value of your investment. Learning curve, moderate, requires understanding of how REITs work and the different types of properties they invest in. Passive income potential, great, REITs are known for paying high dividends. Tax efficiency, great, can be held in tax-advantaged accounts like ISAs. Risk level, medium, less risky than buying a single property, but still subject to real estate market fluctuations. In our hypothetical example, if you had invested $100 in a REIT 4 years ago, your investment would now be worth $98.59, representing a small loss of 1.41%. However, you would have also earned $11.93 in dividends, resulting in a total return of 10.52%. This demonstrates the potential for steady, passive income from REITs, as well as the importance of diversification and long-term thinking when it comes to real estate investing. Cryptocurrencies, the Wild West of investing. Cryptocurrencies have captured the attention of investors around the world, with the potential for massive gains and losses in a relatively short period of time. While not for the faint of heart, cryptocurrencies can be a compelling investment option for beginners who are willing to take on a higher level of risk. The learning curve for cryptocurrencies is moderate, as you'll need to understand the basics of how they work, including the concept of blockchain technology, wallets, and exchanges. Once you've grasped the fundamentals, you can start exploring different cryptocurrencies, such as Bitcoin and Ethereum, and how their supply and demand dynamics can impact their value. When it comes to passive income potential, cryptocurrencies offer a couple of options, such as staking and yield farming. Staking involves locking up your cryptocurrencies to help the network process transactions, and in return, you earn rewards. Yield farming, on the other hand, involves lending your cryptocurrencies to others and earning interest on them. However, it's important to note that the tax efficiency of cryptocurrencies is generally poor, as even swapping one cryptocurrency for another is often considered a taxable event in many countries. Additionally, the high volatility and risk of cryptocurrencies make them a speculative investment rather than a reliable long-term strategy. Learning curve, moderate, requires understanding of blockchain technology, wallets, and exchanges. Passive income potential, moderate, opportunities for staking and yield farming, but also high risk. Tax efficiency, poor, cryptocurrency transactions are often subject to capital gains taxes. Risk level, very high. Cryptocurrencies are highly volatile and speculative in nature. In our hypothetical example, if you had invested $100 in Bitcoin 4 years ago, your investment would now be worth $652.24, representing a staggering 552.24% return. However, it's important to remember that this level of growth is not typical, and many cryptocurrencies have lost significant value or even failed entirely. While the potential rewards of investing in cryptocurrencies are enticing, the risks are also substantial. If you do decide to explore this investment option, be sure to do your research, start with a small amount of capital, and only invest what you can afford to lose. Gold, the timeless safe haven. Gold has long been considered a safe haven for investors, as it is often seen as a hedge against inflation and economic uncertainty. Investing in gold can be a relatively straightforward process, with two main options: physical gold, such as coins or bars, or gold exchange-traded funds, ETFs. The learning curve for investing in gold is low, as it doesn't require the same level of in-depth research and analysis as individual stocks or cryptocurrencies. However, it's important to understand the specific tax implications of your gold investment, as the rules can vary depending on the type of gold and your location. One of the key benefits of gold is its potential to preserve wealth during times of economic turmoil. Unlike stocks or cryptocurrencies, gold doesn't generate any passive income, but it can be a valuable addition to a diversified portfolio as a hedge against market volatility. While gold is generally considered a low-risk investment, it's important to note that it doesn't have the same growth potential as other asset classes. The opportunity cost of investing in gold can be a downside, as your money may not grow as quickly as it would in stocks or cryptocurrencies. Learning curve, low, straightforward process of buying physical gold or gold ETFs. Passive income potential, 0. Gold doesn't generate any dividends or interest. Tax efficiency, good, can be held in tax-advantaged accounts like ISAs, with specific rules for physical gold. Risk level, medium. Gold is a relatively stable investment, but lacks the growth potential of other asset classes. In our hypothetical example, if you had invested $100 in gold 4 years ago, your investment would now be worth $140.10, representing a 40.1% return. While not as impressive as the cryptocurrency example, this steady growth demonstrates the value of gold as a long-term wealth preservation tool. Index funds, the lazy investor's path to wealth. Index funds are often considered the simplest and most straightforward way for beginners to start investing. These funds are designed to mirror the performance of a specific market index, such as the S&P 500, providing instant diversification and exposure to a broad range of companies. The learning curve for index funds is low, as you don't need to worry about picking individual stocks or actively managing your portfolio. Once you've set up your investment, all you need to do is sit back and let the market do the work for you. One of the key benefits of index funds is their potential for passive income through dividends. While the focus is primarily on long-term growth, many of the companies in the index pay dividends, which are automatically reinvested or distributed to you, depending on your preferences. In terms of tax efficiency, index funds can be a great option, especially if you hold them in a tax-advantaged account like a stocks and shares ISA or a Roth IRA. This can help you maximize your returns by avoiding taxes on dividends and capital gains. When it comes to risk, index funds are generally considered lower risk than investing in individual stocks or cryptocurrencies. By diversifying your investment across hundreds or even thousands of companies, you're spreading out the risk and reducing the impact of any single stock's performance. Learning curve, low, straightforward process of investing in a broad market index fund. Passive income potential, moderate, potential to earn dividends from the underlying companies. Tax efficiency, great, can be held in tax-advantaged accounts like ISAs or Roth IRAs. Risk level, low, diversification across a broad market index reduces individual stock risk. In our hypothetical example, if you had invested $100 in an S&P 500 index fund 4 years ago, your investment would now be worth $179.57, representing a 79.57% return. This steady growth demonstrates the power of index fund investing, making it an excellent choice for beginners looking to build wealth over the long term. Diversifying your portfolio, the key to balanced investing. Now that you've explored the different investment options available, it's important to remember the importance of diversification. By spreading your investments across a range of asset classes, you can balance growth, stability, and risk in your portfolio. Personally, I've allocated the majority of my investments to index funds, as I believe they offer a reliable and low-maintenance path to long-term wealth. However, I also maintain smaller percentages in individual stocks, REITs, cryptocurrencies, and gold to take advantage of the unique benefits and growth potential of each asset class. Remember, the key to successful investing is to start early and be patient. Even small amounts of money can grow significantly over time thanks to the power of compounding.